Thanks, everybody. I'm Adam Gelter with 3CDC. We are here today to talk about crafting a real estate development budget. We're going to try to hit this from the very, very basics all the way through some more complicated examples of real estate budgets and how they come together and the different pieces involved. We want to make this interactive. I think we all agree we'd much rather just take your questions as they come versus wait until the end and trying to hold and remember your questions. So feel free to raise your hand while we're speaking, and if you have a question, I'll call on you and we'll try to answer it as we go. We also should have time at the end for Q&A if you do want to hold your question. But I want to start by going down the line and letting the panelists here introduce themselves. We'll start with you, Jen.
Great. Good morning, everyone. Thanks for having me. My name is Jennifer Walke, and I'm Vice President of Development for the Model Group, and we're a local real estate construction and property management company in Cincinnati with the mission to positively transform communities.
Brian Ogawa, I'm Director of Planning and Pre-Development at the Port Authority. We do many things, including public finance, managing the Hamilton County Land Bank, and really starting to invest in most of our disinvested markets in the city.
I'm Sarah Bettinghouse. I am a development director at 3CDC. I primarily oversee mixed-use buildings in over the Rhine, new construction, historic rehabs, and complicated projects with tax credit structures.
Good morning, everyone. Chad Gagnon with Eagle Realty Group. I'm on the structured equity team. Real estate umbrella of Western Southern Financial Services. Eagle Realty is the real estate subsidiary. We have about $4 billion of equity, mostly in multifamily, industrial, and hospitality assets around the country.
Thanks. And so we've got a little presentation here that actually is a modification of a presentation that Sarah and I put together that we use for some students that we teach at UC who are not finance students, are just trying to get the basics around real estate. And so some of this is going to, as I said, start pretty basic. So just to start, we're going to talk about two different types of budgets. So there's the capital budget, how much does it cost to build what you're looking to build? And so that budget will have both the cost, but then hopefully also the sources, how you're going to pay for those costs. And then separately, there's the operating budget. So how's this thing going to perform as it goes on? So that's income versus expenses to get your net operating income. Obviously those then have a relationship between the two where you're trying to pull the capital budget, use the operating budget to inform the sources of the capital budget. Sarah, you want to talk a little bit about what goes into a capital budget and how we at 3CDC go about starting a budget from scratch? So you got a building, you want to renovate it into apartments over retail. What do you do?
Sure. So when I'm building a budget, I typically separate it into a couple of sections. The first section is acquisition. So this is any cost associated with acquiring or holding the building. And so you want to make sure that you're thinking about not just the cost of acquiring the building, but any cost associated with carrying the building while you are doing your pre-development work. So do you have to pay utilities or property taxes or interest on a loan? You would want to consider that when you think about how much you hold in your acquisition line in your budget. The next section is your hard costs. So these are your construction costs of anything that's physically going into the building, into the asset. This could include tenant improvements, demolition, stabilization. You want to make sure that you're thinking through all the costs that might hit this budget as it entails to actually physically improving or constructing the building. And then the next section is all the other soft costs that are associated with this. So you really want to think about what are all the other costs that don't get permanently constructed on the site, but you're going to need to pay it during pre-development or during construction. So these are things like hiring your architect and your engineer, any due diligence items that your bank or lender or investor may require, surveys, environmental testing, legal fees, anything that's not physically being constructed in the building. And then the last part is your contingency. So contingency is essentially a bucket for unknowns. A lot of people structure it as a percentage of hard costs, but it's really a factor of how much risk you're carrying in the project. As you continue to pin down line items in your budget, you can reduce your contingency, but this is really your bucket of money that you have to spend if you've miscalculated something or if something unknown comes up in your project, you would pull that from the contingency. That's sort of, we can come back to any questions about this, but that's sort of my first stab at constructing a budget.
And Jen, think back to before you had your own construction company working for you at Model Group. When you're looking at, you have a building and you want to sort of estimate the cost, maybe back in the day before you had your own construction company and now, how do you go about sort of getting your arms around construction costs, and what are the different ways you might determine what you at least have an estimate of hard costs is?
The best determinant of hard costs is to ask the people who are in the construction industry. So getting estimates, even before you have drawings, you can talk through what you want to do and say, what in general, what are square foot costs to build market rate apartments right now, or commercial? You're going to want to keep your finger on the tab of the market. And once you're into it and ingrained in the industry, you're gonna be a little bit more sensitive to fluctuations, and know yourself. But make friends, talk to people. To add on to what Sarah was saying, there's a lot of costs that could go into the hard cost bucket or the soft cost bucket. So talking to your general contractor and figuring out who's actually paying for the permits, or who's holding the builder's risk insurance, so you know that cost is covered and it doesn't surprise you at the end of the project, or when at closing when you don't have it budgeted for. And then the other thing about soft costs is that you really need to know your project. So every project is different. The Model Group specializes in community development, so we've never done the same project twice. So we've got new construction to historic rehabs, all around the city, developing. We don't do a lot of greenfield development, but some developers do. We have a lot of brownfield sites that we do development on, and so just knowing what kind of the pitfalls are and being able to tailor your soft cost budget to that particular project is really important. I like to think back on one of 3CDC's projects. It was Washington Park, but they had a line item in their budget for grave reinterment because Washington Park was the site of an old potter's field. And that's not something I'd ever seen in a project budget before, but it's just knowing where you're developing, understanding the issues associated with the site. I will say for the new developers, the greatest mistake I see new developers make is underestimating soft costs. A lot of people will get an estimate from a general contractor and say it's $5 million and say, I've got a $5 million project. And then I have to be the bad guy to say like, oh, you don't. It's a lot more than that because we've got to add in acquisition, we've got to add in architecture, all the different soft cost fees, and oh, what about developer fee? Like, are you paying yourself? What are you charging for yourself? So soft costs are an important and very nuanced part of the development project.
And I assume at Eagle we are evaluating other people's budgets more than putting our budgets together, and maybe you could talk a little bit about what you see on the capital budget side. What's a good budget, bad budget? What are you looking at when you're looking at it from a potential lender or investor's perspective?
Yeah, that's right, Adam. So at Eagle, in my role, it's more or less we're the limited partner in some of these development deals or acquisition deals where we're putting in, say, 90% of the equity, the GP or the sponsor's putting up the other 10% of the equity, and obviously getting some kind of 50 to 65% loan to cost, financing from a bank or a debt fund, et cetera. But yeah, we're evaluating these budgets to make sure they make sense to us. We might beat up the budgets a little bit by adding in some extra cost on our side just to make sure there's some cushion and a little bit more contingency on top of what the developers bring to us. But as you guys might know, developers are very opportunistic and energized about some of their deals that in essence sometimes just don't get done. They just can't find the capitalization or the financing to make those deals happen.
And so in summary, what we're, I think, all suggesting a little bit is everyone's tendency, and we do it as a developers, is to try to make the budget as low as we can, but we also want to be conservative as we're thinking about things, and not, the worst case is that you underestimate your budget and you leave yourself at a problem where you're going to be in a hole. Here's just an example, and we're going to talk some more and spend some time at the end on some more running through a couple actual scenarios of more sophisticated projects. But just to give you a sense, you see all the lines here on the soft costs, whether that's lead, various consultants. Jen mentioned permits in this case are in the hard cost, real estate taxes during construction? If you have a broker who's going to sell or lease your things at the end, do you need an operating reserve to get you started if you're leasing up, or that sort of thing? So these are all the kind of things we want to make sure we're thinking about as we look at this. Now moving on to an operating budget. So, knowing what it costs is obviously critical. How you're going to pay for it is equally critical. And so in order to make sure you have a deal that makes sense, you got to understand the operating budget. So rents, what income are you going to get from this project? Then you've got obviously your expenses. This is going to be different from commercial and residential. So again, maybe, I don't know if you want to talk a little bit about how the port, Brian, puts together an operating budget or looks at someone else's operating budget if you're doing this.
Yeah, I think the port is a very interesting entity as a land bank, but I think kind of picking back off Eagles, we do a lot of hole poking in other people's operating budget, and our biggest fear oftentimes is not that projects won't get to a financial closing, meaning your construction lender is on board, your equity is on board. Our biggest fear is in this operating phase where before it's stabilized, lease up is complete, that something happens along the way and people have a certain expense that they did not foresee coming. Maybe their real estate taxes are too high, maybe their utilities are too high, and that these projects and these properties actually fold from an operation, people start losing money. At the port, because we do a lot of riskier deals in areas where the markets aren't quite as profitable, we oftentimes look at our operating budget across several different projects to make sure that if our public finance business arm or our residential real estate arm is going to dip or see an influx of cash, that we can offset other losses elsewhere. So just making sure that you're as thorough as possible and knowing that there are a lot of things to change, so making sure you always also build into a contingency in those.
Sarah, when you are looking at this, obviously if you have a big enough project, it may make sense to engage an actual professional third party to give you some sense of what they think rents might be in your area. Most of the time, even our projects at 3CDC aren't big enough to make that make sense financially. And, we have the benefit of having past history of projects to get pricing from. But if you were going to start off, on your own, 6-unit apartment building in Northside, how would you go about thinking about setting rents or estimating what those rents might be?
Sure. So the first thing I would probably do is just start to honestly look on the internet. So start to see what other market or what other apartments or commercial spaces are going for, and start to plug those numbers in as well. You can always make calls to real estate agents or brokers, and they're typically happy to run these reports for you. I think there's a lot of online resources, but one thing I would emphasize both in the capital budget and the operating budget is that it's an iterative process. And so it's fine to kind of take your best guess and then continue to refine the numbers. So I would start by plugging in an assumption on $1 per square foot rent and assumptions on the expenses that I'm looking at. And then as I continue to work during pre-development, I would continue to refine and refine and refine. And it's fine to continue to revise that budget as you kind of put in placeholders and then make steps to get those placeholders more firm. Don't feel like the first number that you put in is what you're locking yourself into. You can learn and refine it as you go along.
Now, less fun than income, expenses. This is a similar process, I believe, but is there anything else different about, we want to talk about how we're looking at expenses and what things we might want to make sure we're covering? When you're looking at, the port's looking at a deal, what are the things that you're looking at in expenses? What are the categories? What do you, is there some examples of things maybe people miss?
Yeah, I think for the Port Authority, and maybe not everyone's going to be in the same type of project, but we do a lot of residential rehab. So a big thing that we have in our expense portion of our pro formas is a large CapEx or CapEx reserve to know that if we're buying properties out of receivership in bulk, or if these are older properties that they'll need some sort of capital improvement, maybe it's 5, 10, 15 years, but making sure that we're setting aside funding as when times are good to start offsetting those costs when they need to come in. Something that we do a little differently is we don't have real estate taxes, so it's easier for us to kind of add those things together.
If you don't mind, if I can add to that, I would also encourage you when you're looking at your anticipated expenses to be aggressive in that. So it's better to overestimate your expenses and then exceed your performance expectations than it is to try to make it like start with a really lean operating pro forma and then something happens and suddenly like you're underwater. So although it may make your budget look better, you want to make sure that you're building in enough cushion that if something goes wrong, you have some wiggle room and you're still going to be able to pay your debt or pay your investors or overall just perform on the project to your expectations.
Percent agree with that comment. It's more likely for your expenses to increase than decrease, and there's not a lot of levers in your operating expenses that you can control personally. You've got your real estate taxes, so those are set by someone else, and if you don't pay those, you're in big trouble, so that's a non-negotiable. You've got your insurance costs. You're not setting those as well. We've got legal bills to create leases. Maybe you have an eviction. Maybe something happens on site. You want to have legal in your operating expense line item. And then there's admin personnel fees as well. So who's going to do your property management? Is that you? Is that someone else? Is that your staff? But they need to get paid regardless. So who's ever collecting the rents, doing any compliance? And then typically there's some kind of management fee wrapped into the operating expenses. And in the world that I'm in, it's usually around 8-9% of operating expenses, but that's the first thing to go if you have an overage. It's hacking away at your profit and your fee, and that's not a big cushion. So like what Sarah says, try to be aggressive, try to overestimate what you think expenses will be, and stress the deal a little bit, because in operations, it's more likely for you to be surprised in a bad way.
Yeah, and just to piggyback off that real quick, we've all missed on development budgets and operating budgets as well, but some things on the national level we've seen that really have caught us is real estate taxes and insurance here recently, especially in some of the coastal markets down in Florida or Southeast Houston, et cetera.
Yeah, and the other thing I will mention is when if you're looking at residential, one thing that is the hardest thing for us to manage is the cost of unit turns. So someone leaves, accounting for that vacancy time, but then also, maybe they messed up the carpet, maybe you got to repaint, maybe, something's broken, you got a deposit from them, but is that enough to cover those costs? And I think that's a piece of management that you got to think through ahead of time, and then how you're going to build those costs into it. Even if you're going to do it yourself, you're going to still have to buy the paint to repaint that unit. You're still going to have that time between tenants where you're going to have to account for that loss of income. And so making sure you do that. On the commercial side, when you talked about, going out and asking folks to get some more information about rent. If you do have commercial tenants, want to caution you that, understanding when you're getting those, are those numbers triple net, gross, or modified gross? And what that means is the tenant paying the cost of the expenses? Are you passing through real estate taxes and insurance? If so, that rent's going to be lower. What you don't want to do is to have someone tell you, I can get $15 a square feet for a space in Walnut Hills, and then you find out that that's a gross number, not a triple net number, and you've got the expenses, or vice versa. So making sure you understand what goes into those rents when you're asking folks what they are, and that you have a plan of how you want to charge your tenants and how they're going to pay their expenses, or you're going to pay for them, is going to be very important at the outset. All right, so now we're going to talk a little bit about taking that. You've got your pro forma, you've got some positive cash flow. How do you turn that into the sources for your project? Maybe we're going to get into some more complicated examples later, but maybe we can just start at a high level again. If you're, going to a bank, Jen, to talk about one of your projects, what are they looking at as far as how they're going to look at providing you a loan?
Well, the bank's first going to look at all of your assumptions and make sure that they agree with them. So, and then if they agree with your income and they agree with your expenses, they're going to look at how much cash flow is left at the end of the day, and they're looking at debt coverage ratio. So Typically, they're going to want to see a 1.2 or greater debt coverage ratio for at least a term of 15 years, maybe even longer, depending on the lender. And they'll work with the current interest rates and size the amount of debt they're willing to lend you based on those numbers.
Yeah, and as it says up on the screen, the debt coverage ratio is, the ratio of your cash flow to the payment you're making them. And again, they want to have some cushion essentially, so that if you did miss an assumption here or there, you still have the income to pay them back. And so that's going to limit the size of your loan. Even if you have the money in your pro forma, they're going to sort of give you a haircut before they give you the size of the loan. The other piece that's going to help the size of the loan is loan to value. And you want to talk a little bit about how Eagle looks at loan to value and what you think various investors or lenders would look at?
Yeah, so if we're talking about a construction opportunity, I would say most of the regional lenders are coming in these days at 55% loan to cost. A couple years ago, that number might have been up to 65%, and then maybe down to 50% over last year. So I think the lenders are starting to come back in the market. We're definitely seeing it from some of the regional lenders that maybe were kind of took a pause on lending on new development or new opportunities. But for the most part, debt is out there. It's just a matter of getting the right fit for your project.
Yeah, and the value of your building is in the eye of the beholder here. It's not necessarily what it costs you to do the building. That's sort of irrelevant to the bank. As long as you have enough sources to pay it, they're not going to be looking at what it costs. They're going to look at what they think it's worth at the end. They're typically going to use some kind of either get an appraisal or use some kind of cap rate on your income. And a cap rate is sort of made up percentage, but they're going to have industry standards of where they think those are for a residential multifamily, and say, okay, if you have this income, we're going to divide it by this cap rate, we're going to get to this value, and they're going to max out at the high. Either one of these can reduce your loan. So you may have the debt coverage you think to do it, but if they think you have a high cap rate, a risky property, that the loan to value may still limit what you can do on a loan. And so you're going to have to look at both of these things as you go into the bank. And I would say the more you can already do the bank's work for you, and I'm interested to see what some of the folks that are lending to people think, but the more you can do the bank's work for them and say that you've already looked at the loan to value, already looked at the debt coverage ratio, you understand what they're looking for. I think the more credibility you have, the more likelihood they're going to view you positively. You guys who are actually looking at, that's what I think as someone who's borrowing, but as lenders or investors, is that what you guys feel like?
As a public finance agency at the port, and at a previous life was doing public finance at the city of Cincinnati, the more you can give us up front and kind of do that work, A, the much easier the conversation is going to be, and B, the much quicker your process goes. But I think I want to point out what Adam said is really understanding the numbers from a value perspective, I think is one of the larger gaps we see as we work with newer developers, where they come in and they have a bank loan that says, they can get $500,000 if and only if it appraises for $2 million. And the whole time they're going through the pre-development, they're carrying the assumption that they have a $500,000 loan. Well, turns out that their project appraised for, 75% of what they thought the value was, and all of a sudden they're coming back to us in the 11th hour with a $200,000 gap. And so the more you can understand that the bank is coming from an area of mathematical equation with your expenses, your debt coverage ratio, your income, and being able to have that conversation goes a really long way.
Anything else to add from the panel before I go to the next and talk a little bit about equity? So the bank's going to give you a haircut. They're not going to loan to the full value of the building. They're going to have coverage against your payment on an annual basis. So you're going to need equity to make up the difference. That equity can come from a number of different sources. It could be your own cash. It could be investors. It could be grants or other sources, government sources or otherwise. But you're going to need this extra money to fill in the gap. And I think, one of the things that you're going to want to look at is what are your investors or you looking to get in a return from this? And so really thinking through, how skinny are you willing to make this deal? How much risk are you willing to take on with your own money or your investors' money to make this work? And so not just say, well, I can raise $100,000 from people, but how am I going to get that $100,000 paid back and then have that folks make some money? I think this is something that is going to be as critical as the debt, and thinking through whether, you know, you're looking at an opportunity and whether this makes sense for you to pursue. Are there any other thoughts on that? Everyone in the crowd's been very quiet. I said raise your hand and ask questions. Is there any questions as we sit here right now? Yeah, we're happy to provide these slides and send them out to everyone. And so we'll work with the folks to make sure there's somewhere that you can either download them or where they get sent out.
There's a couple other questions.
Oh, good.
You said the banks, they look at what it's worth, what it's going to be worth, as opposed to how much it's going to cost you to build.
Correct. So yeah, the bank is only interested in what it's worth in the future, not what it costs. And so they're going to ignore what it costs to some degree and ask you to come to the difference between what they think they're willing to lend, which is less than what it's worth, and what it actually costs. And they're going to ask you to come up with the difference, which is what leads us into the last slide that we have for this section. And we're going to keep going with questions, but you either need to have the equity and have that equity make sense, or you need to find, if the cost is more than what the bank is allowed to provide you, what you think you can provide a return in your investment, then you need some other sort of source, whether that's a grant from the city, a tax abatement, utilizing tax credits, other sources to fill that gap. In the back on my right.
So you said that right now we're seeing real estate taxes and insurance being escalating in cost. Between the two of them, insurance has more likely to escalate in the short term. So between the convergence of the bank, the equity, the syndicator, and like other diverse pots of funding like the city, public funding, et cetera, where are you finding that they're coming to a meeting point about how to make these projects work?
Yeah, I mean, I think it really depends. I mean, there's definitely probably still, even with interest rates where they are and everything, I'm sure there's projects out there that just make sense. They pencil out, the rent you can get, you get a good deal on a building that's in good shape, and you can spend a little bit of capital on it and make a deal work. That still is possible, but for all of us except for probably the folks from Eagle, we're dealing with things that are usually typically don't work. When we do all the work that we just described, we get to the end, and that's why we have become experts is maybe a strong word, but we've been well versed, a lot of experience using the various other sources to fill the gap of these things, and I think it's important. And I think we're in a good position. I think the city, the county, where we do all our work, are aware of the need that these projects have, and I think working with Cincinnati Development Fund, the port, other folks to develop programs and other sources to help meet those needs. And so I'd encourage you, as you have these projects, to engage with Cincinnati Development Fund, engage with the city and their team, because they do want to help make the projects happen genuinely. But you've got to do, as we said, you can't just walk in there and say, I have this building, help me do it. You got to have done all your work and said, this is what I need, and this is why I need it. And if you can tell that story, I think there's really people out there that are interested in helping it. Again, I don't know.
I think you bring up a really good point about there being so many different players and sources of funding you can go after. And I think a short answer to your question is no, they don't always align in what they're looking for. And that's your job to herd all the cats and get everyone going in the same direction that you need them to be going with. But really, when you're underwriting, you need to underwrite to the most conservative underwriting requirements. So, you've got 5 different lenders. You're going to need to pick the most conservative benchmarks from each one of those to try to underwrite your deal if you're going to incorporate all 5 of those sources in your project.
And then I think also as you start to look at different sources, understanding that some of those sources come attached with affordability restrictions, come attached to leasing restrictions. So understanding that sometimes you might think a source covers your gap, but it may actually increase it.
And if you find yourself working on a project that doesn't make direct financial sense, so in other words, it costs more to do your project than you're going to make, and then you're looking at these other incentives like grants and tax credits and other development incentives, you want to think through who is offering those and what are they trying to achieve. So if you're looking to the city of Cincinnati or the state of Ohio, they want to get the project done, but they also want to create jobs and bring tax revenue back to the city. So you can also do some of the pre-work on that side of it too and start to think through telling your story of, if you help me get this project done, I'm going to bring 10 jobs to this neighborhood and I'm going to create 20 units of housing or whatever it is. Certain providers of incentives will care about that more than maybe a traditional bank, but you being able to tell that story will put you one step ahead and looking like you know the greater impact and can try to attract that incentive.
Yeah, I had a question on you're putting together your pro formas and what you were assuming for rent. Like I saw an example where it's like $1.8 in OTR space, but I see also like a glut of apartments. Like we're trying to convert like 1,600 units downtown. There's big developments like right off Liberty and other things. So like, how are you like out in your pro forma doing vacancy? Like, how's that gonna impact rent growth?
If we knew the answer to that question, we'd all be a lot richer than we are. No, but you bring up a really good point. It's something that we talk about a lot, and I don't think there's any direct answer other than, again, being a little more conservative than you think you need to be. Whether that's building in more vacancy than it's going to be. You're going to only get to a 92 to 95% vacancy if you are killing it, because units are going to turn and you're going to build that, sort of reduce your income by that amount anyway. And if you have a feeling that the market is saturated, then you're going to want to have that number be lower. Or even though that rents are at $1.80 in OTR, you're feeling like there's so many units coming on, you want to underrate it at $1.70 to make sure you're comfortable. And as long as you can tell that story of why you're doing it and explain that this is why you want to do that, I think people will be appreciated. You're thinking forward through that. I mean, I will say that at this point, all the units that come on downtown, all the units coming out of the Rhine where we do most of our work, haven't really had any impact, and rents still continue to tick up slightly. But that's just not going to be true forever. I mean, there will be a point in time where rents will go down. It's just how the world works. So we got to be prepared as you can be for that time.
And I think it's also obviously tied into population growth, job growth, creation, and what overall momentum is happening in the city. So there's a lot of, guesstimators that you got to
Yep.
come up with.
You can also engage a third party to do a market study. They will put together a big report and look at all of these factors: population growth, economic drivers, lease-up rates, on other projects coming on the market. You can capitalize that into your budget if you think that would benefit your project. So it's typically, I don't know, $4,000 to $10,000 maybe. But if your pre-development budget can support that, that might really be a good benefit to have that knowledge as you're developing your budget and going to the banks. Some banks might require it too.
So I really have two questions. One is for Eagle. When you talk about your investment stake in some of these developments, can you talk more specifically about what your average investment cost is? Most banks have, a minimum amount that they want to invest or to entertain, and then they have a maximum. And then the second thing I'd like to talk about is low barriers of entry opportunities for people. And that surrounds around land bank properties and how they can utilize some local sourcing in order to get involved, do a project, right? But do it in such a way that, the scale of it gives them experience before they go on to try to tackle some of these larger projects.
Let me, if it's okay, let me have Brian answer that second part first, and then I'm going to let Chad go through some of his slides, which I think maybe will answer some of your questions that you had for Eagle, if that makes sense. So Brian, you want to?
Yeah, I think the barrier to entry is something that truthfully at the land bank report we've been ebbing and flowing, trying to find the right balance with. On one hand we have land bank property in neighborhoods of disinvestment, and because they're land banked, they're cheap, they're well maintained. We have some grants to clean them up, take out buried foundation, make them a little bit more development heavy. But But then on the other hand, those properties in land bank, because the private market couldn't figure out how to make money and invest in them. So there's this balancing act of, yes, low barrier to entry on the acquisition side, but probably high barrier to entry on the risk capitalization side, your exit strategy when you're going to refinance, what the sales comps are. So it's kind of a moving target. It really depends on your risk appetite. I always tell people, don't be swayed because you think you can get a land bank lot for $5,000. It's $5,000. You still might have to build a $300,000 home, and do you think you're going to be able to sell it for $305 just to break even? So it's kind of a balancing act. I always say, I hope none of my city friends are in here, but I always challenge them to say, well, if we're investing all of this money into affordable housing in difficult neighborhoods and trying to amplify emerging developers, what if we took that same subsidy and got them properties in Hyde Park, Mount Lookout? So it's just kind of that balance between upfront capital and your risk on the back end.
All right, Chad's going to talk a little bit, get back to the first question here, and he's prepared some slides. We'll kind of use some of them to talk through it, so go ahead.
Yeah, so to answer the first question, I put together a couple of slides here on just some live opportunities or deals that we've closed here recently or going to close. So this first one was actually a deal that we closed down in Dallas last year, multifamily development deal, 350 units. So to answer the question about size, most of our investments are on the larger scale. We usually put in $15 to $40 million of equity. So these are pretty large deals, which requires a lot of equity, a lot of debt, and just our larger unit sizes here. So we have this kind of the sources and uses broke out. We actually used Fifth Third as a lender out of Dallas to finance this deal. It's a local developer sponsor. Return on cost metrics is something that we look at. So an untrended return on cost, that 623 number there on the slide, is basically your NOI divided by your total cost, which is one of the metrics we look into to kind of determine whether or not the deal is going to pencil. Right now, we're anywhere between 625 to 675, maybe up to 7% untrended return on cost, which is about 125 to 175 basis points over the current cap rates. So Adam mentioned cap rates today that are kind of theoretically just what deals are trading on today with the value of the assets. And then kind of the bottom graph there is basically some of our investment returns. So we're looking for most likely 15 to 20% IRR to us as the LP capital, and I have kind of broken out the limited partner equity to the general partner equity, which is usually a 90-10 split, where we're putting in 90% of the equity in the developer, the sponsor's putting up the remaining 10%. So we're really looking for somewhere between a 15 and 20% IRR on a development deal over a 3-year hold, which is kind of what we're looking at today and determine whether or not we're going to move forward on a deal or not.
Is that like a A-class multifamily?
Yeah, if you go back to the first, this is actually it's probably one of the most expensive investment opportunities we've invested in here recently. So we're putting up $40 million. It's a Class A, 5-story wrap deal. There's some different determinations between multifamily deals, wrap, garden, podium, or high-rise. A lot of our investments are more of your garden, 3 to 4-story walk-up, stick-built construction deals. This deal here is a wrap where there's actually a parking garage in the middle of the property, and the units are kind of wrapped around that structured parking structure.
How do you guys model the risk in that? I mean, there's been flood in multifamily, so how do you determine?
Yeah, I mean, going back to your question earlier, I mean, you look at some of these national markets, say Dallas or Austin, where they've been putting on 30 to 40,000 units a year. So there's definitely an imbalance between supply and demand in those markets, which it's going to take a while for rent to kind of get back to moving in a positive direction, and you really need that demand to come back. Otherwise, your occupancy is going to be dipping here in the next couple of years.
Any other questions?
I got lots, but
No, keep going. Let me get in the back, and then we'll come back to you.
Historically, most of I don't know what my calculations I came in a little bit late. A lot of your institutions are not do not do business with people of color when it comes to a lot of the projects and stuff. What type of intentionality are each group I would like each of you to answer in making sure that those things happen in the future?
Yeah, well, I mean, obviously that's part of why we're here, is that, it's important to the city, it's important to all of us to build up what has been, obviously a neglected area where we just do not have enough minority developers in town. They have not been given the opportunities that they need. And so I think we are all very interested in ways that we can help. And speaking for 3CDC, and I said this last year and said this before, even if it's not in our focus area downtown under the Rhine, our staff and myself, we're happy to look at anyone's project and try to give you some feedback and pointers, make some introductions to people that can help move your thing along. The only thing that we ask is that you're doing the work. As long as you're willing to do the work, and we say, hey, we need you to go, this is what you should be looking at for rents. Here's 5 people you're calling. You're willing to call them, get the information, come back and say, what do you think of this? We're always going to be willing to help give you that feedback and then tell you the next step or introduce you to the next person to get you with the right bank who's going to listen to you, or to use our relationship with someone to make sure you get a contractor that's going to give you a fair price to do the work. As long as you're doing the work, we're going to do the work. And that's speaking from 3CDC's perspective. It's something that's important to us, but I'll go ahead and let the model Port.
Yeah, I think at the Port, that's pretty central to our mission. Our Vice President of Economic Inclusion, Jilson's sitting third row. He can raise his hand and you can talk to him after. But we have a lot of intentionality, I think, both on 2 sides of our business. One being our actual vertical development and construction. We have some pretty aggressive inclusion goals for both minority businesses, women-owned, and just small businesses in general. I believe they're a little bit more aggressive than what the city and the county require of us, and because we pride ourselves on it. That's both in our, like I said, our internal development work and for our public finance projects. And then on the more development land bank side, we have a pretty large intentionality of being as flexible as we can for newer developers who want to acquire land bank lots to do projects. We do things that most, probably no other sellers would do. Is we have projects that have been under contract for 3-4 years that we are working and giving technical assistance to developers on. As they've been under contract, we're not requiring earnest money, extension fees, and have really been as patient and trying to be as helpful as possible, kind of push those along.
At the model group, we have also aggressive inclusion goals on our construction team, and with our leasing efforts for our commercial businesses in over the Rhine and Walnut Hills is where we have the bulk of our commercial spaces. But specifically, to answer your question about Black developers, we do partner and have capacity building partnerships and mentoring relationships with people who come to us with questions. And like 3CDC, we're happy to take a look at anything and offer suggestions if anyone's interested.
Yeah, just from Western Southern in general. I mean, we've been a big proponent of growth here throughout the city and over the Rhine and some of the other communities, and partnered with 3CDC and others in town to make that happen.
Any other questions? Yeah, I think, and Sarah mentioned this before, but, I've been at 3CC for 20 years, and when we started, we didn't know what we were doing, and we would just, I was making up pro formas, and I think we kind of hit on it, but we want to reiterate, like, really thinking through the things that you might not be thinking of, because that's what's come, when you look at that, even in the capital costs, we've got now, we have got to the point where we have a standard capital budget form that has all the lines you think you might have, and some of them aren't relevant to every project, but that way at least you're thinking, do I need a lead line item in this number? Is the bank going to require me to have inspections every month, and I'm going to have to pay the $150 or $250 a month to the inspector to come out to my property, look at it, and tell them it's okay to give me the money? I mean, those are things that, like, we didn't know when we started, and that, typically those aren't huge things, but every little thing starts to, and the thinner your deal is, the harder it gets. So I think that's why I would also encourage you to rely on folks, if you're getting started in this and if you haven't done this, I think relying on folks like ourselves who are willing to take the time to look at your budget and say, hey, did you think about this? Did you think about this? Did you think about this? Because as long as you're willing to put together, like I said, the time to do it, we're happy to take the time to help you. And I think then when you go to the bank, what you're describing about the bank not lending money to minorities is a very real thing. I have real examples of times where folks, if you took A and B and you didn't tell me anything else about these two deals and which one gets funded and which one doesn't, it's crazy. And so I think, being able to have that experience to come in knowing all your thing, where everything's, and be able to say, hey, 3CDC looked at this budget, or hey, Model Group looked at this budget, Eagle Realty looked at this budget, the port's on board with what we're trying to do. I think that also can help go a long way to convince those folks that you know what you're doing, and that's the hardest part. Starting out, that's the hardest part. So relying on that help while you're doing that, I think is important. Anything else, anyone?
Yeah, we have a lot of lessons learned as well. I would say my first piece of advice is to know your market and tailor your development to meet a need. And that need is not all of the needs. There's a lot of times you want to say like, oh, well, we have a need for family housing, we have a need for singles, we have a need for seniors. Like, let's put it all in one building, and that becomes difficult. So maybe narrow in on one of the needs in your community and say, oh, okay, well, this is going to be a building for singles. We're going to have efficiencies in 1-bedrooms. I'm going to market it to this population, so my marketing efforts are tailored in one direction, not all the directions. My other piece of advice is to ask a lot of questions. Know the requirements of all of your partners. Feels like there's a lot of fees that pop up, right? If you're closing on a construction loan, you're going to pay the bank interest. You're going to pay the bank a closing fee. Oh, you're also going to pay the bank for all of their due diligence on your deal. They're going to order an appraisal. They're going to order a market study. They're going to hire legal counsel to review your environmental reviews. And they're going to have all their legal closings too. So that's another 25, 35 grand potentially that can go into your pocket or into your budget. The equity investor, the folks, if you're using tax credits, who are buying your tax credits, a lot of times they have asset management fees for the whole compliance period that they want you to capitalize up front. And for typical low-income housing tax credit deals, that's going to be 80 grand per project. And then they might have their own fees on top of that for their due diligence. So just ask a lot of questions. Know what you're getting into, understand the requirements. And then I think a third big lesson learned is not all grant money is free. And so I'm going to call out the Community Development Block Grant Program specifically, because if you have more than $2,000 of block grant funds in your construction deal, it's going to trigger a prevailing wage to be paid on your whole construction contract. And so you need to make sure that the amount you're getting in grant funding is worth it, because prevailing wages can add, 20% to total project costs. And so it could actually cost you more money, which Brian alluded to before. So just something to look out for.
Yeah, before we get to the next question, I want to reiterate something Jen said, like, not just of your finance partners, whatever, asking questions and not being afraid to ask questions till you understand something is really critical. Whether that be your contractor, whether that be your lender, whether that be your equity folks, like, we're using a bunch of words. If it's not familiar to you, like, just keep asking till you understand it, because if you don't understand it, that's when you're going to make a mistake. And so don't feel silly or embarrassed if you don't know what a cap rate is, or you don't know why the bank's looking at this way, you don't know why the contractor says they got to do it this way. Just keep asking till you understand it, because once you understand it, then you have the power to deal with it.
Yeah, Adam, can I add one? I think one other big lesson we learned at the port through both our individual self-performing work and our land bank work is really trying to understand both your risk tolerance and your investor's risk tolerance up front. Meaning that sometimes you're going to have to walk away from a deal if you're not, like us, a mission-based entity, and the folks up here. Sometimes the deals, no matter how hard you push and how conservative you are and how aggressive you are in rents, like the deals just aren't penciling. And so I think especially in the riskier market that the land bank works in is there's a self-fulfilling prophecy of this deal has to work, we've sunk a lot of soft costs in, but if you don't understand how much risk you want to put in up front, at least a vague idea, you might end up in a situation where you sunk a bunch of money in, you have a lot of due diligence, but then you're only seeing a 2-3% return on investment, everything goes right. So having that conversation with your partners up front is always really helpful.
I hear you guys on the ask questions. A lot of times when you're dealing with a community that isn't accustomed to coming to you and knowing what questions to ask, I'm wondering if it's customary for you guys to give like a list of things that you're looking for or things that you need from us. I understand, you know, us doing the due diligence, you know, and a lot of people who are stepping in this realm are willing to do the legwork. The challenge is it's a real life situation for me. 2019, I was going after a larger piece of property, and I felt like the bank that was dealing with me, you know, had me running around in circles. I had to keep coming back to provide information when the whole process would have been a lot more efficient and simpler if I knew exactly what it was you guys were looking for. You know, so I can just get that information, come back, let's get it. I missed that deal because the whole process just took too long. Somebody else came in and got it. Thankfully, I was able to get the deal 5 years later. No, 4 years later, but I had to pay $40,000 more. So, is it
Yeah.
necessary for you guys to a checklist of what you need?
Well, I think two things. One is, you know, us at 3CDC and model as well, we are not lenders, so we don't, you know, we're not doing that. But what you're describing with the back and forth of the bank is something that is pretty customary, unfortunately. I don't mean to disparage any of our banking partners. We wouldn't be able to do what we do without them, but like, they're just not set up to, they are not set up to cater to you in the way that, you know, we wish they would be. So there is a lot of challenge, and that's why I was suggesting that leaning on folks who've maybe had to go through this, unfortunately, because it's our full-time job, many times, to give you some advice on what things to put together and how to do it, is what I'm suggesting. But maybe the folks who do actually look at what people put together can talk about whether they have a list or you know, some kind of due diligence sheet.
Yeah, so not a sheet or a list, but if you ever apply for a land bank property, it is bemoaned a lot to us, but we have a lot of pre-closing contingencies that will say specifically, make sure you do your geotech, and we're going to check that you did that before we close. Did you talk to your bank? Did you get your appraisal? You know, what's your pro forma look? And we kind of spell it out as a checklist that we don't want to close. Like I said at the beginning, our biggest fear is not that you don't close. Our biggest fear is that in 1 or 2 years your project goes belly up. So in our purchase agreements, it might be different than your bank, and it might be different from project to project, but we do have those kind of listed out in all of our purchase agreements, and we'd be happy to kind of share that too.
I just wanted to add that your experience sounds very familiar to me as well. Most recently, I had an environmental review process take 23 months, and that's just reviewing paperwork. And so I think if you're looking at the whole development world as, you know, your role as developer is to get something done, but to mitigate risk to everyone's satisfaction. Like you can never mitigate all the risk, but having sufficient capital up front so that you can sustain a pre-development loan for 2 years for an environmental review, you know, while that gets done is an important piece of it, and having a little cushion up front.
We have time for one more question, if anyone.
So those are great points you made. You said that as a developer, the job would be to mitigate risk and get things done. So I have a question. The question is, if I was a developer and live in the community, that maybe own houses in the community, I would want those people to stay in the community. And there's missions that the city of Cincinnati and the port has that makes it difficult for some of these homeowners to stay in the properties by way of building code violations and just making it so expensive for those homeowners to stay in those properties. What I wanted to know is, are there programs that we could market to those homeowners that would help them with those repairs? Because I'll give you a scenario. I bought a house for $8,000 from an old lady who was getting ready to lose a place because of building code violations. And I tore the place down and got drawings to build two $600,000 homes. And the human in me is like, she had this place for 30 years. Sometimes development push people out that worked hard to stay there. So are there programs to help those people? That's what I'm asking.
Yeah, I think at the port at least, I don't want to speak for the city's building inspection department, but in pretty much every neighborhood where we have a large, especially residential portfolio going on, so think of neighborhoods like Evanston, Avondale, the West End, we try and always couple, we have a long conversation with the community about what
I think it was a simple question.
well, I'm going to get, so we have a conversation about, affordability, market rate, and figuring out what they want to build, and then we couple that with making sure that we have some grant money, whether it's through LISC, the city of Cincinnati, the state, to do a home ownership repair for those legacy homeowners to be able to access, if there's a code violation by the city, that we will then pay for, whether it's redoing the roof, the stairs, exterior blight, some tuck pointing. So we always try and couple those programs with neighborhood that we are heavily, and we can't do it in every neighborhood, but at least the ones that we know that we're affecting the market most.
Where do those homeowners get access to that? Is that public or?
Yeah, it's public, just on our website. Yeah, so we do, I'm not sure if we have any of our land banks after you, but we list it on our site. We put up, essentially because we're active in the neighborhoods, we put up QR codes on all of our lots that kind of have access to that information. We distribute it out through the community councils and the local community development corporation.
And then I also believe the city of Cincinnati, at least over time in the past, has some programs available. People Working Cooperatively is a local nonprofit that helps with homeowner repairs, but I would suggest you talk to the Briannas who are sitting at the city of Cincinnati table out there and ask them for more pointed information about their programs currently.
Working in Neighborhoods has grant programs for home ownership improvements as well, and I know there are some neighborhood-specific ones. Nest and Northside has some. Council on Aging. Anybody else know any grants that you want to scare? Habitat?
Well, unfortunately, we're out of time here. I think, at least for myself and maybe some of our other panels are willing to stick around a few minutes and answer any questions, but they're flashing the red paddle at me over here that we ran out of time. Thanks everybody for your time.